Hey there, this is Dario Kerkez, Certified Financial Planner, IHT Wealth Management, and today we're going to be talking about the retirement plans. So we're going to be talking about retirement plans today because they're clearly not only different retirement plans in which we can deposit money and save, but they're also differently taxed. So let's start with the most common one, which is 401k plan. 401k plan is employer-sponsored plan, which is funded based on your payroll deduction agreement. So you decide and you sign an agreement, I'm going to be deducting, let's say, $500 a month, and then it comes in the form of pre-tax deduction of your gross income, and through payroll deduction is coming to the 401k plan that is sponsored by your employer and as a custodian. That can be a Vanguard, Fidelity, or whoever that is. That custodian receives the money and it's going to be invested according to the allocation you specify. Now the money is going to be invested and it's going to be, the growth will be tax deferred as long as the money is in the plan. And that tax deferred growth is going to be enhancing the performance as on an annual basis. There's just no annual 1099 for any dividends or for any growth or for any sales or trades or for any realized gains, to put it that way, that you accomplish inside the 401k plan. So everything is tax deferred, everything is growing tax deferred until you decide that after the age of 59 and a half, which is a magic age when there's no penalty, you can start taking money out of there. But you will sure enough pay 1099 or ordinary income taxes. Today, in state of Illinois, only federal income taxes, no state taxes apply. They might change it, we don't know when. We'll certainly go into more details in different videos for the 401k because they're very complicated in nature with all the features, benefits, etc. Let's go to number 2. That is a Roth IRA. Roth IRA or Roth 401k is a type of account in which you contribute asset or your money or your dollars on after you paid income taxes, but everything is accumulated, not only tax deferred, so you can make and realize gains on an annual basis, but you will not pay any income taxes or capital gain taxes while doing so, and because the account is deferred. But not only that, in case you pass age 59 and a half or you come into retirement, you can certainly use money and any withdrawals will be considered tax-free withdrawals. So that is very important. So in essence, we can have a 401k or an IRA type assets, which is tax deferred. We can tax deduct it initially, but everything will be taxable in the future. Option number 2 would be Roth IRA, which is we pay income taxes, we put then we put in the money, and then everything grows tax deferred, but then everything is tax-free in retirement. Second or third type of an account is going to be individual or joint account. They can be individual, joined with a spouse, or actually even trust account. And in that case, we can invest also after-tax dollars. But in case we're invested or we make any sales, we're going to be realizing gains or losses that we can net against each other, and then we can have either capital gains or capital losses in any year and use that either against or add that to our income taxes. That one is not subject to age 59 and a half. It's always liquid and should definitely be part of the one's portfolio in case you have any discretionary income or any savings that you like to deploy to make some money on it. Very often people ask me about and let's name that as a 1, 2, this can be 4, as a real estate. Real estate income can be very beneficial in case you're going to be, but in that case you're going to be involved in managing assets. Real estate has many tax advantages. We're not going to go that here, but you can definitely use, with real estate, you can use leverage, you can use borrowing the bank's money, other people's money, you can participate in full appreciation, you can then exchange that commercial property to to another. It's called a 1031 exchange. We're going to go in deeper for those things as well, and also you can utilize depreciation and all the other tax advantageous things associated with real estate in case you want to generate retirement income through real estate. And let's go to number 5. That would be life insurance as a supplement to a retirement income. In case we have type of accounts like index universal life, variable universal life, or whole life cash value policies, and we enhance cash deposits into those policies while we're keeping protection for our families, not only we can have the life insurance or death benefit, we can also have income benefit or some other living benefits associating with that, and use that to supplement our retirement income. And in that case, that will be acting similarly like a Roth IRA, which means that the withdrawals will be used on a tax advantageous basis, mostly as a tax-free income. So those are 5 major types of retirement accounts that the Americans are using today, and you can definitely give us a call, email us, or fill in the form below, and then in case you have any questions, we'll be happy to help you. Thank you very much. Have a great day. Bye.